Welcome to the Deep Dive, the show that cuts through the noise of market data to deliver the insights you actually need.
Today, we are jumping straight into a really critical earnings report that, frankly, sent some shockwaves through the retail sector this week.
Yeah, this is a big one. We're talking about a major retailer who really acts as a barometer for, the U.S. housing market and just general consumer sentiment.
And this quarter, Q3 fiscal 25, it definitely failed to meet expectations.
Right. So our mission today is pretty simple. We're going to cover the headline miss. We'll get into the unexpected pressures management talked about, and then we'll connect it all to this big strategic pivot they're making that is just, well, it's compressing margins right now.
And that's really the core tension, isn't it? The third quarter was undeniably mixed, and the market reacted very negatively.
So let's start with the financials.
Yeah.
The top line, the sales number, it actually looked okay at first.
It did. Net sales landed somewhere between, $41.35 and $41.4 billion.
Which was a beat. It was $200 or $300 million over what analysts were expecting. That's 2.8% growth year over year. So, not bad.
But, and this is the profitability story was just completely different, a real letdown.
Okay, so what happened there?
Adjusted diluted EPS, earnings per share, came in at $3.74. The street was looking for $3.84.
Wow, so a 10-cent miss. That's significant.
It is. And what's really critical for you to understand is that this is the third consecutive quarterly miss on EPS.
The third?
Yeah, that starts to look like a pattern. It suggests maybe some internal over-optimism on what they can actually deliver.
And when you drill down into comparable sales, that revenue growth starts to look a little shaky too.
Very shallow. Total comps were just barely positive, up 0.2%. U.S. comps were even thinner at plus 0.1%.
So how did they even get that tiny bit of growth?
It was all on price. Or, a higher average ticket. Actual traffic, the number of transactions, was down 1.4%.
Okay, so fewer people are coming in.
Exactly. But the average ticket, what people spend when they do come, that was up 2.0% to about $90.
So fewer shoppers, but they're buying slightly more expensive stuff. That feels like consumer hesitation to me.
It is. They're making the necessary purchases, but maybe not those frequent small trips you'd see when people are feeling more confident.
That makes sense. Okay, let's unpack the miss. Management always has reasons, right? What was the big factor they pointed to?
The biggest one they cited, and this was interesting, was the complete absence of major storms in Q3.
Storms, you mean like hurricanes?
Yeah, hurricanes, major weather events. For this business, storms are a huge unplanned catalyst. They drive immediate demand for high-margin stuff like roofing, repair materials, generators.
Huh. And that just didn't happen this quarter.
It just never materialized. They said October in particular was weak because that storm-related demand was a zero.
Wait. Are they just blaming the weather? I mean, isn't that a bit of a convenient excuse for just, softer underlying demand?
Well, it's both, right? The underlying demand is soft, but the lack of weather just amplifies the miss because it's something they usually count on.
Okay, so what about those bigger structural headwinds?
The core problem is still the housing market. It's just so sluggish. Housing turnover, the rate people are buying and selling homes, is at a 40-year low.
A 40-year low.
It's at 2.9% of the housing stock. I mean, people just aren't moving.
And if people aren't moving, they're not doing those big renovation projects.
Exactly. When you buy a new house, you almost always do some work. A new kitchen, new floors. When you're stuck in your current house with a high mortgage rate, you'll do maintenance, but you're probably putting off that $10,000 discretionary project.
And this is where it gets really interesting, because management isn't just sitting around. They're trying to fight this with a huge structural change.
That's the whole long-term story here. They keep talking about gaining market share, especially with professional contractors, the pros.
And they're not just talking. They're putting serious money behind it with M&A.
Huge money. They're trying to pivot from just being a big box retailer into more of a hybrid retailer-distributor.
Okay, explain that. What does that actually mean, hybrid retailer-distributor?
Think of it like this. The big box store is your general practitioner. It serves everybody. The specialty distributor, that's like the surgical supply chain. It's for the pros handling huge, complex orders of materials like drywall or steel studs that get delivered right to a job site. They want to own both sides of that.
And the big move recently was the GMS acquisition.
That's the centerpiece. SRS, which is their specialty distribution arm, just closed that $5.5 billion deal for GMS in Q3.
And GMS is a distributor of things like drywall, ceiling materials.
All those specialty building products, and that deal alone added about $900 million in revenue in just 8 weeks.
So you combine SRS and GMS, and suddenly you have this massive distribution network aimed right at the pro, completely separate from the retail stores.
Absolutely. Now you're talking over 1,200 specialty distribution locations on top of their, 2,350 retail stores. The goal is to be a one-stop shop for the pro.
And they're using tech to try and lock those pros in. I saw something about blueprint takeoffs. What is that?
This is actually a huge deal. It's a tool that uses AI. So historically, a contractor gets a blueprint for a big job and has to manually count every single thing they need, every sheet of drywall, every stud. It's slow and you can make mistakes. It can take weeks.
And this new tool does it how fast?
They're claiming it can deliver an accurate material estimate like almost instantly. It turns weeks into minutes.
That's a massive advantage.
It creates a sticky relationship. You're not just offering a discount. You're solving a huge pain point for that pro contractor. You're saving them time so they can go bid on the next job. It ties them right into your ecosystem.
And that focus on the pro seems to be what's holding up the numbers that are still positive. Like big ticket transactions, anything over $1,000 were up 2.3%.
That's right. But management was really clear that this wasn't, a sign that DIRs are back doing big remodels.
So where did it come from?
It was mostly appliances, power tools, and these big pro initiatives taking share from smaller competitors. So they're basically growing their slice of a pie that's shrinking overall.
Okay, let's pivot to profitability, because this is where the market really got spooked. The margins took a big hit.
They did. And you can see the impact of the M&A written all over it.
Right.
Gross margin was basically flat year over year at 33.4%.
Okay.
But the adjusted operating margin, that got compressed. It went from 13.8% last year down to 13.3%.
And that was from the GMS deal.
A mix of things. Transaction costs from the deal, higher overhead, and what's called incremental amortization from the acquisition. It all adds up.
They also built up a lot of inventory.
A lot. It's up $2.3 billion from last year to $26.2 billion. Now, about half of that is just absorbing GMS's inventory.
And the other half?
That was a deliberate choice. They're investing in having more product on hand to make sure their delivery network is fast and reliable for those pro customers. It's a cost of doing business in this new model.
So if we look ahead, what does this all mean for the rest of the year? We have to talk about the guidance, because that's really what triggered the sell-off.
It was. The revised outlook for fiscal 25 is a real step down in their earnings power. Total sales growth, they actually revised up a little to around 3.0%.
But that's only because of the acquisition.
100%. It's purely because GMS is expected to add about $2 billion in sales for the full year. It's not organic growth.
And the bottom line, the earning.
That's where the pain is. Adjusted EPS is now expected to decline approximately 5% for the year, a 6% decline on a GAAP basis.
That's a huge swing. How much of that is the cost of the strategy, the M&A drag versus just the soft sales environment?
They tried to break it down. They lowered the full-year operating margin target by 40 basis points down to 13%. They said about half of that, so 20 basis points, is just the inclusion of GMS, which has lower margins, plus the transaction costs.
And the other half is just not enough sales to cover their costs.
It's deleverage, yeah. Not enough volume flowing through the stores to cover their fixed costs.
And I heard Q4 is going to be even messier because of the calendar quirk.
Exactly. Last year, Q4 had 14 weeks. This year, it only has 13. That 1 week difference alone will create about 50 basis points of expense deleverage for the quarter. You have the same rent, basically the same payroll, but spread over 7 fewer sales days.
So that brings up the big question. Why did the market hate this so much? The stock dropped about 6%, which was way more than options were pricing in.
I think the market is worried about two bad things happening at once. One, the consumer is weaker than we thought, which the housing data confirms. And two, the company's spending a ton of money on this big strategic pivot at what feels like the absolute worst point in the cycle.
Investors hate that combination.
And you see it in the relative performance. Stock's down about 16% over the last year. Meanwhile, the consumer discretionary sector, the XLY, is up around 23%.
Wow, that is a massive gap. So this isn't just the macro environment, this is company-specific pain.
It really is. The pro strategy, long-term, could be amazing. It opens up a huge new market for them. But right now, today, all investors can see is the margin dilution and that 5% EPS decline. They need to see proof that this is all going to pay off.
And management basically said they don't see any help coming in Q4, right?
Yeah.
No lower interest rates, no housing rebound.
None. They said the underlying business, if you strip out the storm issue, is running at about a 1% comp. And they have to rely entirely on that pro strategy just to hold that line.
So they're fighting economic gravity with strategy, but the cost of the fight is what's dragging them down.
That's the perfect way to put it. The vision is clear, but the pain is immediate.
Which brings us to our This Is Not Financial Advice segment. How do you possibly play this kind of complex situation?
Well, the market is clearly punishing the stock for the near-term earnings pain and discounting the long-term story. The whole tension is that M&A strategy. It creates value, but the integration costs, the amortization, it's just crushing the current EPS numbers.
The market has priced in the housing weakness, but maybe not the full extent of this M&A drag.
I think that's right. So the outrageous but plausible trade idea here would be a short-term pair trade.
Okay. Break that down for us.
The idea is you initiate a short position in the stock. The thesis is that the stock is just going to drift sideways or even down until the company gives some real, tangible proof that the GMS and SRS integrations are creating synergies.
Or until the housing market just magically turns around.
Which doesn't seem likely, and to hedge out the broader market risk, you pair that short with a long position.
So you go long something like the S&P 500.
Exactly, something that has less direct exposure to the housing cycle. That way, you're isolating your bet. You're betting on this company's specific M&A-driven earnings pressure, which will cause it to underperform the broader market.
And what's the catalyst to get out of that trade?
The target would be to cover the short after their investor conference on December 9th. If they come out with really strong, believable data on cross-selling and synergies, that could be enough to re-rate the stock. If they don't deliver that proof, well, the short could have more room to run.
So to sum it all up, we've seen how a modest revenue beat was just completely erased by a big EPS miss and that downward guidance revision.
And it was all driven by the weak housing market, no help from the weather, and this new M&A pressure. The key takeaway for you is that this company is in the middle of a necessary multi-year pivot.
But in the short term, investors are only focused on that 5 to 6% EPS decline.
So you have to watch the catalysts. Any sign of housing stabilizing is one, but the big one is tangible proof of cross-selling success between the old business and these new distribution arms.
That's what has to overcome that margin pressure for the stock to work again.
It's all about operating leverage from here on out. They need to show that sales growth from the pro strategy can outrun all these new fixed costs.
Thank you for joining us for this deep dive. We hope this analysis helps you move forward well-informed.